Hello everyone. Let's review the declining balance depreciation method using a comprehensive problem. Mara Resorts purchased air conditioning equipment at the beginning of 2023 for $40,000. Residual value at the end of an estimated 4-year service life is expected to be $3,000. Calculate depreciation expense, accumulated depreciation, and book value for the entire useful life of the equipment using the double declining balance method. First of all, it's important you realize equipment is a long-term asset. Long-term assets are resources owned by the business that benefit the company for periods beyond the current fiscal year. Long-term assets are typically referred to as fixed assets or PP&E and are listed on the balance sheet as property, plant, and equipment. The cost of long-term assets is allocated over the useful life of the asset. For PP&E, that cost is known as depreciation expense and is presented on the company's income statement. Pause your video at this time and look at the key concepts related to long-term assets that I've included here. Now let's solve the problem. First of all, what are we doing? We're calculating the depreciation expense, accumulated depreciation, and book value for a piece of equipment. Second, how are we going to do it? We're going to use the declining balance method. The declining balance method is an accelerated depreciation method where a constant percentage is applied to the book value of the asset. Third, relevant data. Relevant data for PP&E accounts include the acquisition cost, salvage or residual value, and service or useful life. Now let's solve for our problem. Our first step is to determine the depreciable cost. To determine the depreciable cost, we take the acquisition cost of $40,000, the residual value of $3,000, subtract the two, and we get the depreciable cost. Now remember, the depreciable cost is the total cost management expects to use up of an asset. It's the asset's cost minus its estimated residual value. In this problem, $37,000. $37,000 is the maximum amount of depreciation expense that can be taken on this asset. Next, we want to determine the constant depreciation rate, or CDR. The CDR is determined by taking the declining balance rate and dividing it by the useful life. Because this is a double declining balance problem, we use 200% as our numerator. Converting it to a decimal, it's 2. Divided by the useful life of 4 means that we're going to get a CDR of 0.50 or 50% a year. We will use this 50% throughout the problem to calculate the depreciation expense for each year. We are now ready to calculate the depreciation expense, accumulated depreciation, and book value. The depreciation expense will always be the CDR times the book value of the asset at the beginning of the year. The accumulated depreciation will be the accumulated depreciation at the beginning of the year plus the current depreciation expense. Finally, the book value will be the asset's original acquisition cost minus its accumulated depreciation. Let's solve the problem using a depreciation schedule. The first column is labeled year, second column book value, beginning of the year. Third column, constant depreciation rate. Fourth column, depreciation expense. Fifth column, accumulated depreciation. And the sixth column, book value, end of the year. In year 2023, the book value at the beginning of the year is $40,000, which equals its acquisition cost. The constant depreciation rate to be used throughout the problem is 0.50 or 50%. The depreciation expense for the year 2023 will be determined by multiplying the beginning of the year book value of $40,000 by the constant depreciation rate of 0.50 to give us $20,000 of depreciation expense for that year. Since there was no prior accumulated depreciation, the accumulated depreciation at the end of 2023 is $20,000. The book value at the end of the year is then determined by taking the original cost of $40,000 minus the accumulated depreciation of $20,000 to get the book value at the end of the year of $20,000. The book value at the end of any year is also the book value at the beginning of the next year. So in 2024, the book value at the beginning of the year is $20,000. The constant depreciation rate is 0.50, so our depreciation expense is $20,000 times 0.50 or $10,000. Since our accumulated depreciation had a prior balance of $20,000, we'll add the depreciation expense for 2024 of $10,000 to get a new ending balance for accumulated depreciation of $30,000. The new book value at the end of the year then will be the original cost of $40,000 minus the accumulated depreciation of $30,000 or $10,000. The book value at the end of 2024 is the book value at the beginning of 2025. So we take our $10,000, multiply it by our constant depreciation rate of 0.50, and for 2025 we get depreciation expense of $5,000. Our accumulated depreciation will now total $35,000. The $30,000 from 2024 plus the $5,000 of depreciation expense in 2025. The book value for the asset at the end of 2025 will be $40,000 original cost minus $35,000 accumulated depreciation, or $5,000. The $5,000 end of year book value will be the beginning of the year book value for 2026. When using the declining balance method, the final year of depreciation can be tricky. For this problem, multiplying the book value of $5,000 by the CDR of 0.50 gives us a depreciation expense of $2,500. When we add the depreciation expense of $2,500 to the 2025 accumulated depreciation of $35,000, we get a total accumulated depreciation of $37,500. That $37,500 represents the total depreciation that we've taken over the life of this asset. With an accumulated depreciation of $37,500, we have an ending book value of $2,500. The problem that we have is that at the beginning we determined the depreciable cost to be $37,000 and not $37,500. And the residual value would be $3,000 and not $2,500. We avoid this issue by ignoring the constant depreciation rate calculation in the final year and taking the depreciation expense amount needed to reach $37,000. In this problem, instead of depreciating the asset by $2,500, we depreciated $2,000 in the final year. By taking only $2,000, the accumulated depreciation totals $37,000, and the book value at the end of the year, or at the end of its useful life, equals $3,000 as required by the initial calculations. That's it. Some key observations that you need to make are: 1, for declining balance, you always multiply the constant depreciation rate by the asset's book value and not by the depreciable cost. 2, when determining the constant depreciation rate, don't round. Enter your numerator, enter your denominator, divide the two, and whatever the CDR rate is, use it without rounding the numbers. 3, in the final year, depreciation expense will be the amount necessary to increase accumulated depreciation to the depreciable cost amount and reduce the book value to the residual value. Do not let the accumulated depreciation exceed the depreciable cost or book value fall below the expected residual value. Finally, when using declining balance, know that it is possible for a long-term asset to be fully depreciated before the service life used to determine the depreciation rate. I hope this video helps with your understanding of the declining balance depreciation method. Take a second to look at the problem. Solve it yourself to make sure that you're understanding everything. Thanks for watching the video. Good luck.